Hello guys and welcome back to a new video. Today I'm excited to share with you 3 changes that I made to my trading that took it to the absolute next level. These changes helped me become more effective with my executions to achieve a higher win rate and significantly improved my trading psychology. And it made my trading stress free. And the best part is that these changes aren't exclusive to any specific trading style or strategy. No matter how you trade, no matter how style you are using, you can easily incorporate these tweaks, and I'm confident that you will see results. Now, some of these changes are psychological, while others are pure technicals. But before we dive into the video, make sure to click on the like button if you find value in this video and the previous videos, and don't forget to subscribe so you don't miss any of my upcoming videos. Now, without any further introductions, let's just get started. So the first change that I made is related to how I approach the time frames during my trading session. So as traders, we know, or we all should have both a higher time frame and a lower time frame. Of course, you can use time frames in between those two, but the key focus should always be on the higher time frame and the lower time frame, right? So the change that I made is simple. When I start my trading session, I only focus on the higher time frame. On my screen, there is only the higher time frame chart visible. I don't even glance at the lower time frame unless the price taps into a key level that I have marked, or a level that price might potentially react from, right? So for me, this is a strict rule. No checking the lower time frame until the price reaches a key level of interest. Now, how does this make trading more stress-free and improve my executions and my discipline to follow my trading strategy? So most mistakes happen when we spend too much time looking at the lower time frame. Why is that? Because simply we see something that appears promising, for example, an entry pattern, an impulsive move at displacement, right? Or a break of a high or a low, and it tempts us to take action. We tend to forget what the higher time frame is doing, and instead we try to justify that lower time frame setup, and we almost every single time we convince ourselves that it is valid, even if it's not. So the lower time frame can trigger a lot of emotional reactions or responses, because it shows constant potential trades, stop losses, take profit levels, right? And also entry signals. So it feels like it is the closest step to making money, right? That's why the emotions are high there, unlike the higher time frame, right? I believe you noticed that too. So this constant stimulation, right, can really overwhelm you, and it will eventually lead you to impulsive decisions. Again, on the other hand, when you focus on the higher time frame, you're not emotional. You are simply observing where the price might want to go, the direction, identifying levels where the price could react. So you're not seeing precise stop losses or take profit levels. So there is less temptation. So by simply staying on the higher time frame, you avoid the noise on the lower time frame. By noise, I mean those setups that appears valid, but they are not aligned with your higher time frame. So you are not constantly needing to filter out the setups that don't align with higher time frame, because sometimes you will do that filtration process effectively, but when you are not in the right mental state, right, when you don't have the willpower, sometimes you will give up and you will take those unvalid trades. So instead of doing that, simply stick to the higher time frame, right? So this one simple change, focusing solely on the higher time frame until price reaches a key level, this can make a huge difference in your trading. And that's the first change that I wanted to share in this video. Now, the second change that I made was working on my invalidation levels. Understanding exactly where to place my stop loss and identifying the point at which my trade idea would be invalidated. So, in other words, invalidation is about knowing the price level where, if hit, it is highly unlikely that the trade will go in my favor afterwards. So, for example, if my trade idea is bullish, right, and my stop loss is triggered, there is a 90% chance that price won't reverse and then hit my take profit level, right? By knowing the invalidation level, I know that there is a good chance that price won't reverse on me afterward. So this is a really critical and important concept, because many traders out there face a common problem, which is they correctly predict the market direction, right? But still somehow get stopped out repeatedly. They might place their stop loss just below a recent low or a recent level, behind what seems like a strong level, right? And what happens is that price hits their stop loss, right? And then reverses and moves in their favor. They enter again, set another stop loss, the same thing happens. So the issue right here isn't their directional bias, it's their stop loss placement. And to fix this, I started focusing on it during my backtesting and studying hindsight charts and focusing again only on that specific thing. So started identifying specific levels where if price reaches them, my trade idea would be no longer valid. Now, these levels are unique to my trading approach and the concepts that I use, right? Such as market structure and DTFX. So that's why I can't really give you the exact rules that I use. So you will need to figure this out for yourself based on your trading style and the concept you follow, right? For me, sometimes I use the sweeps or the failed breakout when price fails to take a previous swing, right? I know that there is a good chance that price won't come back to that level, but again, there is more to it, and it's not just a simple mechanical process, right? You need to put in the work, right? Now, of course, using the invalidation level might require placing wider stop losses, but it also means your take profit levels will likely to increase as well, right? Because if you are right about the direction, your trade will have more room to play out, right, without getting prematurely stopped out. Now, while using a tight stop loss is really risky and it requires a lot of experience with your specific strategy, not experience with trading, but experience with your own strategy to identify where to put tight stop losses to get a bigger RR. So as a new or intermediate trader, start with using wider stop losses, that it will build your equity, it will build your confidence, and it will make you stick with your strategy to make it work on the long run, right? Because a lot of traders abandon their strategy and then they start jumping from one to another without understanding or have a deeper understanding of that strategy. So this is not a simple concept and it requires to put in some effort and practice. However, improving your understanding of invalidation levels will definitely increase your win rate, and it will also reduce the frustration, right? It will prevent situations where the price hits your stop loss and then moves to your take profit level, because that frustration often leads to impulsive trades, right? Revenge trading and deviating from your plan. So as you can see, that this concept will improve both your technical edge, right, and technical understanding of the market, and also it will improve your psychology. So this change right here made a huge difference for me. and I'm sure it will do the same for you. Now, the final change that I made was understanding which market cycle we are in during the trading day. During the trading day, to be particular, because I'm a scalper. It could be during that particular week if you are more of a swing trader, right? So what do I mean by this? The number one reason traders abandon their strategies and jump to another is that their strategy suddenly stops working. It worked perfectly for a period of time, everything seemed fine, and then it stopped delivering results, right? Although they were taking the same setups, following the same entry criteria, but now they are facing a losing trade after another, and they have no idea what's going on. So the cycle you were trading in before is no longer the same. Markets move in cycles, right? There are times when the market is expanding with moderate momentum, times of heavy momentum, right? Like the recent moves in NQ, right? Following the FOMC, we saw that the market dropped 1,000 point, followed by 400 point retracement. Then there are consolidation cycles, right? Some consolidations occur in a tight range, while others we will see constant manipulation of the highs and the lows. And this one is really tricky because it creates that illusion, right, of price is breaking out, right? And you want to trade in that direction while we are still inside a range. And you are still trying to apply your trend following strategy in another cycle. So the main point right here is applying the same strategy across different cycles is a disaster, right? A strategy designed for a trending market won't work in consolidation. A strategy designed for trending days with moderate momentum, it won't work in trend days, right? In trend cycles where the momentum is really heavy. In the first one, you have time to wait for that pullback. You have time to think. You will have the best are possible, right? Because you are getting those pullbacks into your point of interest, right? You take price higher. It won't work in heavy momentum. Price will not give you that. It will lead to frustration, missed trades, and then it will lead to impulsive decisions, impulsive trades, right? Same goes to consolidations, right? So this concept may sound simple, but believe me, it has caused me a lot of losing days. Now, however, fortunately, I never abandoned my strategy. And that's what everybody do when they face a series of losing trades with their strategy. So more often than not, it's not the strategy that's broken, it is the context in which you are applying it. So instead, I focused on identifying and studying market cycles. At the start of my trading session, the first task that I need to do is to determine whether the market trending, what is the momentum, right? Are we consolidating? Are we manipulating the highs and the lows? And based on that analysis, I decide whether my strategy is suitable for that current day or current condition, right? Whether I should stop or whether I should jump in. And that requires discipline, right? So it's not easy to make that decision. It's not easy because you constantly want to trade. So making the decision to sit on your hands, it requires discipline. And sometimes I still make mistakes. I misread the cycle, I act too quickly, right, without considering the bigger picture. But being mindful of these concepts, of the market cycles, improved my results tremendously. So these three changes, right, refining my understanding of invalidation levels, that's the first one. Improving my stop loss placement, right, recognizing market cycles, right, and the trick to always watch the higher time frame in front of me. I never watch the lower time frame unless price taps into a key level, right? I promise you, if you implement these concepts the right way, you will see results. Now, I hope you found this video helpful. If you did, leave a like, comment, right? And if you have any questions, feel free to reach out to me on Twitter and I will answer you as soon as I can. Now, happy trading and good luck.